So if you happen to look at the stock chart for EKSO, that's ticker EKSO, you just see a sea of red.
A big flash of it.
A huge one. I mean, we're talking about a massive, sharp 18% drop right after a major announcement. Right now, it's trading under $9. The analysis report we've been looking at actually had the price at $8.64. And your first thought is disaster.
Failure. Something's gone terribly wrong.
Exactly. But the material we've got suggests something completely different. It claims this price action is actually the setup for what it calls, and this is pretty provocative, the single biggest AI arbitrage opportunity of 2026.
That is a colossal claim. I mean, it really frames our entire mission for this deep dive.
It really does.
And for anyone listening, arbitrage here just means a pricing gap. The market hasn't caught up to what's really happening.
Right.
So our job is to really dig into the financial arguments, the corporate maneuvers that are outlined in this analysis, and figure out if this claim holds up. Is what looks like a classic scary dilution event, actually, an early EKSO IPO into AI infrastructure.
And we have a really tight focus here. It's one analysis report, and it's all about this one trade, this one idea. It's the ultimate buy the dip story around a rebrand that's about to happen. So let's start at the very beginning, because the first step really is a complete mental reset.
It is. The very first thing the source material tells you to do is, well, it feels counterintuitive. It says, ignore the exoskeleton name.
Which is hard to do. That's what the company is known for.
It's a real struggle because the market sees a medical device company. But according to this research, that old EKSO, the struggling one, is effectively being deleted and replaced with a pure play AI entity.
Okay, so let's talk about the actual mechanism of that deletion and replacement. This isn't just a new logo and a press release. You called it a corporate transplant. How is that actually being done?
It's a very sophisticated move. The whole thing is driven by a massive spinoff from Applied Digital, it's APLD.
A big player in the high-performance computing space already.
A giant. And APLD is carving out its entire cloud computing business, a fully functional existing division, and it's merging it directly into the shell of EKSO.
Wow.
So the old medical device business is, for all practical purposes, just dissolving into this much bigger, much more valuable business that's coming in.
So you're taking this, sluggish legacy body and just injecting a high-growth, high-octane business right into its core. And I guess with a new core, you get a new identity.
Precisely. The outcome of all this is the immediate birth of a new company, and it will be renamed ChronoScale.
ChronoScale.
And the analysis report is very, very specific about what ChronoScale is meant to be. They don't just call it a cloud company, they call it a pure play, high-performance AI cloud infrastructure beast.
That phrase pure play, that's really crucial, isn't it? It signals they're not messing around with legacy stuff. They're focused entirely on the high-margin, specialized needs of AI.
It absolutely is. And the scale, it already justifies that aggressive label. This isn't some startup with a bunch of projections.
It's an existing business.
Right. The material notes that ChronoScale launches with a really substantial foundation. We're talking $75 million in annual revenue, right out of the gate. But the real difference maker is the infrastructure underneath. It's purpose-built, specifically optimized for huge, intensive AI workloads.
And when you say optimized for massive AI workloads, we should probably get specific because that's central to the whole valuation argument. We're talking about NVIDIA H100 GPUs, right?
That is the key technical detail. The report just hammers home again and again. The infrastructure is built around NVIDIA H100s. And for you listening, that matters because these chips are the gold standard. They're the scarce resource that everyone needs for training large language models for generative AI.
They're like gold dust.
They command a huge premium. So if you build a cloud business around these specific high-demand GPUs, you're immediately validating that pure play status. It puts ChronoScale in an elite tier that it attracts premium multiples.
Okay, so let's get to the paradox at the heart of this whole thing then. If everything you just said is true, $75 million in revenue, pure play, built for H100s, a combo that usually sends a stock to the moon, why on earth did the market react with an 18% drop?
And that drop is the whole opportunity. It's the structural anomaly that creates this arbitrage thesis.
Right.
The analysis says the fear, the negative price action, is all down to market confusion. A really myopic focus on the short-term deal terms. They literally call it panic selling by retail traders who saw the headline, glanced at the ownership structure, and just freaked out.
Well, let's not sugarcoat those terms because they are dramatic. I can see why people would panic. What are the specifics that caused that reaction?
The terms are, they're undeniably the risk factor here. So Applied Digital, the company spinning off this valuable cloud business, keeps 97% of the new ChronoScale company.
97%.
And the existing shareholders of EKSO, the people holding the stock around $8.64, they only get a 3% stake in the new combined company.
And that explains the red chart. I mean, if you own 100% of the old company, and you're suddenly told you only own 3% of the new one, Your gut reaction is, I've just been wiped out.
The bears are screaming dilution.
Of course.
And, technically, based on the old valuation, they're not wrong.
Okay.
But this is where the analysis just completely flips the narrative. It forces you to redefine what it is you actually own.
It's that classic trade-off question, right? Would you rather own 100% of a small, struggling medical company or 3% of a potential multi-billion-dollar AI infrastructure giant? That's the whole question of this deep dive.
It really all boils down to the denominator. The market right now is pricing EKSO based on its history. Today, EKSO's market cap, its total value, is tiny. It's around $22 million.
$22 million.
So if you own 100% of that and it's facing headwinds, your growth is pretty limited. That's the old company.
Okay, now let's talk about the new company. That 3% stake looks really small, but the argument is that if ChronoScale gets valued like its peers, the overall the denominator is just astronomical compared to that $22 million.
Absolutely. You have to look at the comps, the comparisons. The report specifically mentions other high multiple AI cloud stocks like CoreWeave or even APLD itself. And just for context, these specialized AI companies, they're often valued at, 30, even 40 times their annual revenue because of the growth that's expected.
So let's actually run that math. I think that's the key insight. If ChronoScale is launching with $75 million in revenue and it trades at, say, 30 times revenue, which is maybe even conservative for this sector, what does the total valuation of the new company look like?
Okay, so 30 times $75 million in revenue. That puts the total theoretical market cap of ChronoScale at $2.25 billion minimum.
Whoa.
And that's the low end. If it gets higher multiples, you're talking $3 billion or more.
And that puts the 3% stake in a totally different light. 3% of a $2.25 billion company is, what, $67.5 million?
$67.5 million.
That's a colossal jump from the $22 million value of the entire old company.
It's exponential leverage. The analysis is basically saying the market, in its confusion, is pricing this 3% stake based on the old sub-$22 million company. But the future valuation, based on industry comps, implies that the 3% stake alone could be worth way more than the current $9 share price.
They're calling it an early access IPO.
That's the term they use. You're trading a small, maybe non-viable slice of a shrinking pie for a slice of a potentially colossal, fast-growing one.
But hold on a second. I get the CoreWeave comparison. It's compelling, but isn't there a risk here? What if the big institutional money sees this not as an IPO, but as APLD just dumping a small asset into a shell company to clean up its books? Does ChronoScale really get that premium valuation right away?
That is the critical question you have to ask. And it brings us to what the report calls the halo effect from Applied Digital.
The halo effect.
Right. The analysis anticipates this exact skepticism, and it argues that the connection to APLD is what provides the validation. It helps it bypass that dumping ground perception.
Okay, so how does that trust transfer work specifically?
It's about governance and a proven track record. The idea is that buying EKSO under $9 is a backdoor way to get exposure to the established APLD ecosystem. ChronoScale isn't starting from zero. They're getting the same management team, the same strategic vision that has already successfully rolled out huge GPU clusters under the APLD name.
So the big investors, the ones who've already put billions into APLD, they already know and trust the team that's going to be running ChronoScale, even with a new ticker.
Exactly. The institutional capital follows the people and the tech, not just the name on the door. And besides that, APLD's own impressive run has been validated by Wall Street. The report we read notes that analysts have price targets for APLD well into the $40s and $50.
So the tide lifts all boats.
That's the thesis. The high tide from APLD lifts the ChronoScale boat. That institutional appeal transfers almost immediately.
Okay, so the strategic benefit is clear. You get top-tier management, you get a proven playbook. But that brings us back to the 18% price drop. If all that is true, why the negativity?
Well, the report frames that 18% dip as a classic behavioral finance mistake. It's a sell the news event.
Okay.
The source argues that this short-term drop was driven mainly by retail traders who just saw that scary 97% figure, panicked, and sold their shares without reading the fine print, without understanding the long-term potential. They just, quote, don't understand the long-term value.
So that implies a pretty big disconnect. I mean, the market's supposed to be efficient, but in this specific case, the analysis believes it was highly inefficient, and that's what created this very specific time-sensitive entry point.
That's the core belief. The inefficiency is driven by inertia and fear. The price right now is anchored to the old medical valuation and that emotional reaction to the word dilution. The opportunity only exists because the new AI-driven valuation hasn't been applied yet.
Which brings us to the timing. The stock is still sitting there at $8.64. If the value transfer is so obvious to an analyst, why hasn't the price already corrected?
Because the main catalyst hasn't happened yet. The analysis is very clear on this. The price is low precisely because the transition isn't final. The stock is still trading under the old ticker,
EKSO.
EKSO. And the name hasn't changed yet, so until that official corporate action is done, the stock is still linked, both psychologically and technically, to its struggling medical past.
And what's the prediction for when that rebrand to ChronoScale is finalized?
The prediction is pretty straightforward. The price will soar. The thinking is, once the name change is done, the new ticker is live, all the sophisticated AI algorithms that the big institutional funds use.
The algos.
The algos. The ones that are programmed to find pure-play AI infrastructure companies with H100 exposure and high growth, they'll start picking it up. And the current price just won't hold anymore. The stock graduates from being a small-cap medical device stock to being an institutional-grade AI asset.
So it sounds like a race against the calendar. The bet is that you can buy the stock now while the ticker still says EKSO before the market's own mechanics, the algos, the analysts catch up to the new reality of ChronoScale.
It is entirely a race against market perception. The report basically argues that once that name changes, this specific opportunity is gone. The market will apply that 30x revenue multiple, and the price will structurally reset, closing this arbitrage window for good.
Okay, so what does this all mean for you, the listener? Let's try and recap the core conclusion of this analysis report. This whole setup, the price drop, the scary dilution, the big rebrand, it all adds up to a very aggressive, high-risk, high-reward play.
The entire investment thesis is contingent on you buying into the current market confusion, or as the authors say, buying the fear.
Right.
You're buying before the formal transition unlocks those AI sector valuations. You're making a huge bet on an immediate re-rating of this new entity.
And that re-rating, that really gets to the core risk here. This whole opportunity depends on a successful transition from that tiny $22 million medical device valuation to a high multiple AI infrastructure valuation. The question you have to ask yourself is, what's the risk if ChronoScale doesn't immediately attract that institutional money that's always favored APLD?
What if that initial $75 million revenue base stalls out? Or what if the market decides that CoreWeave's high multiples are just too aspirational for a newly spun off 3% stake?
Then it doesn't look like an early access IPO.
Then it looks more like a marginalized asset. The analysis suggests this window is closing, that once the name changes, the opportunity just evaporates. So the true test of this whole thesis is whether ChronoScale can immediately achieve that multi-billion-dollar status that's needed to validate this sub-$9 buying narrative, or if it just gets stuck in that critical gap between its old medical past and its hoped-for AI future.